Everyone, this is Don Anders. And as most of you know, our specialty is kind of working with people retiring from the Florida retirement system and drop. And I would say probably half the time that I meet with somebody, their biggest concern is how am I going to pay for insurance once I retire? Now, we're going to do two videos. This video is specifically for people who are retiring before the age of 65. So you're not eligible for Medicare yet, okay? If you're retiring after the age of 65, we're going to do another video specifically about Medicare for those of you retiring at that age. I'm going to go ahead and click it up above. I'm also going to put it down below if you're watching this on a different platform. So the question is, how do I pay for my insurance, right? A lot of you have looked at what insurance will be if you're retiring under 65, and it's pretty expensive. So we're going to get into the three most frequently asked questions. Number one, we're going to get into, if I decide to go with a different plan, will I still get my health insurance subsidy, or do I have to stay with the school board or agency or state agency or sheriff's department or whoever else you might be with? Number two, is my employer coverage COBRA or is it something else? And then number three, should I stay with my employer plan? Okay, so we're going to get into all three of those, and I'll discuss a little bit, and then if you need more help, I'll put a link to our calendar at the end as well. Okay, so number one, will I get my health insurance subsidy if I don't stay with my employer plan? That is a pretty big question, and a very often question that we get, because people think, well, I get my health insurance subsidy, but I have to stay with my employer plan to get it. And for those of you who don't know, you get $5 per year of service to help pay for insurance. And remember, it's $5 per year of service before you enter drop, right? Because once you enter drop, you're technically retired. So it's 5 years of service before you enter drop, and it's capped out at $150 per month. Now, for almost all of you, you get your health insurance subsidy from the Florida retirement system, from the FRS, no matter who you're insured through. So you can be insured through Medicare, you can be insured through your employer, you can be insured through another avenue, you can be insured, some of you might have TRICARE or something like that through the military. So you will get that no matter who you are insured through, as long as you're insured in some way. Okay, so that $150 will come to you. Now, the only exceptions to that are there are certain agencies. So specifically what we've seen it with are fire departments and police departments, where they give you an additional benefit on top. And if you're getting that additional benefit, oftentimes that applies to staying with the agency's insurance, but not always. So if you're not getting any additional benefit, just the $5 per year of service through the Florida retirement system, you're going to get that no matter what. It doesn't matter who you go with. If you're getting an additional benefit, that's a question that I would go to your HR or whoever handles the insurance at your agency and just ask them. Say, if I decide to go with the marketplace or Medicare or something like that, do I still get this additional benefit? And then you can make your decision from there. All right, number two, is your employer plan coverage? COBRA coverage when you retire? This is a very, very common question. A lot of people say, well, I'm going to go on COBRA, but what happens when COBRA ends? Because COBRA is traditionally, if you get fired from a job or you leave a job in the traditional private sector, you can go on COBRA, and that usually only lasts anywhere between 1.5 years up to 3 years. But from my experience, 99% of people do not have COBRA. They just have continued coverage through their work. And the reason I say 99% is because I haven't seen all the agencies out there, right? There's so many of them. But all the ones that we have worked with, which are dozens or probably over 100 at this point, all of them I've seen have had continuation. So almost everyone. I wish I was positive enough to say 100% sure that's everyone, but almost everyone has continuation of coverage, meaning it's not COBRA. You just can continue on the coverage. So this is really important for people who are retiring super young, your police officers, your firefighters, your people who started at a really young age, and maybe you're retiring at 55 or 50. Well, you can continue that coverage, not just for 18 months or 36 months. You can continue it as long as you'd like. And my recommendation is you're probably going to want to continue it until you can reach Medicare age if it makes sense for you. And that gets us to the third most commonly asked question is, what's the best insurance to go with? Now, this really depends on your income. Okay, so if you're making a decent amount of income, I would say $40,000 or $50,000 or more per person in your household. So if it's just you, if you're making $50,000 or more, or if you're married, between the two of you, you're making $100,000 or more when you retire, you probably are going to be best off with your employer plan coverage. And I know that's kind of harsh to hear for a lot of you, because your employer plan coverage, we've seen it anywhere from $400 up to $1,100 per person, depending on the agency. I would say the average is probably in the $650, $700 range, but we've seen it more expensive than that. Okay, so just know it just depends on your situation, depends who your employer is, and depends on your income. Now, for those of you who have a lower amount of income, so let's say you're retiring, you just have your pension, and you're making, say, maybe $25,000 or $30,000 a year for you, or maybe 50 or 60,000 between you and your spouse. Then at that point, it might make sense to go ahead and look at healthcare.gov, because the marketplace on healthcare.gov, they give you a credit. They give you a tax credit that they do it up front. They automatically apply it to the insurance policy to help pay for coverage that you don't get anywhere else. So if you stay with your employer plan, you don't get that coverage. If you go somewhere else, you don't get that extra tax credit. So make sure that you at least go on and shop it. And so what I'm going to do now is I'm going to go ahead, I'm going to switch over. We're going to do a screen share, and I'll show you how to go ahead and look into whether or not healthcare.gov makes sense for you. Okay, just jumped over to healthcare.gov, and healthcare.gov, if you're on here, this is the marketplace. Otherwise known, some people call it Obamacare, but this is basically the marketplace that they have. The benefit of this is you can go on, you can run quotes and do things. Now, one thing that people often say is, well, I have to wait for open enrollment. I'm retiring in May. Open enrollment isn't until November or whatever it is. Yes, with the exception of if you're leaving credible coverage, which you are. If you're retiring, that's an event that triggers you to be able to go on and get coverage throughout the year. Okay, so we're going to go to healthcare.gov. We're going to click up here where it says where it says get coverage. I think I'm already on that page. I am already on that page. Okay, we're going to see health plans and prices. Now from here, it's going to ask you for your zip code. I'm going to put in, I'll put in right in the middle of the state where our office is in Winter Park, 32789. And then we are going to tell them a little bit. It's going to click there where it says, tell us about your household information. Plan ID, we're going to skip that, okay? Skip. Now, this is where you put just you or couple. I'm going to go just you. Just kind of show. I'm going to say I'm retiring at 60, and let's say I am male and I'm not a smoker or pregnant or anything like that. We're going to click on continue, and then here we can add a spouse if we want, but we're going to go ahead and click confirm. And I'm going to put in, let's say that my pension is $2,000 a month. Okay, so that's $24,000 a year. Now, remember, this income, you can click here to see how to estimate it, but this income, if you're taking Social Security, that counts towards it. If you're retiring in the middle of the year and you have other earned income, you have to add that up plus what you earn afterwards. Here's one thing that a lot of people don't consider. If you're going to take a partial lump sum out of drop, so a lot of times, and if you don't know about the different drop payout options, there's 3 of them. Look at our different videos on our different pages, and we go through it, or even attend one of our webinars, we talk about it. But there's 3 different options. And let's say you go, okay, well, I'm going to take out $40,000 out of drop. I'm going to pay off some bills. I'm going to pay off credit cards and, maybe go on a vacation. Well, that $40,000 adds to your income that year. So if you're thinking about doing that, you might want to retire a little bit early, maybe retire in November, take out your distribution in December, so your income's lower the following year for this, okay? It's based on what you earned that year. And don't lie about this, because what's going to happen is if at the end of the year you put in 24,000 and you end up making 50,000, well, all of a sudden you're going to get a tax bill at the end of the year that you're going to have to pay it all back anyway. So it doesn't make any. It's going to be, you're going to be way worse off if you lie about it. Okay, you can't fudge these numbers. Okay, so $24,000. We're going to click on continue. If you are 60, male, in that zip code, you would get a tax credit of $987 per month by going with this option over going with your employer plan. $987, okay? And on top of that, remember, you get your health insurance subsidy. So you get that, based on your years of service, $100, $150 on top of that. View plans. And let me go next. I'll go close. Now I'll walk you through it if you want to read it some more. But here's what I recommend. Now this looks great, right? $0 is I can basically get insurance for free. And if you're not worried about insurance, or you don't really care, this is kind of like a catastrophic coverage. It doesn't cover much. I wouldn't recommend typically going this route, but you can if you want. But really what you want to do is click on add filters. You can look at silver plans, gold plans, platinum. Pretty self-explanatory, right? As you go up from silver, gold, and platinum, it's going to be better coverage. But on top of that, you can add providers, you can add drugs, you can add all that. And then you can go all in here. Then you go down and you can see what's my deductible going to be? What is my maximum out of pocket? Does it cover dental? Does it cover generic drugs or whatever else? And you can go in and you can actually do the research on yourself. Now, I just want to show you real quick, if we go back. So let's say I change this from 24,000 to 40,000. Well, we still get $807 per month that way as a credit. And let's say I change it to 60,000. 591. Now, 591 might sound fantastic, but health insurance is not that cheap on the marketplace, right? So the catastrophic coverage is still $184. And if you got into the silver and gold plans, you're probably going to be paying as much or maybe even a little bit more than what your employer plan would be. And your employer plan is probably better coverage, maybe not. So that's something you want to look into. Now just go on. This is how you research it. We don't sell insurance personally, okay? So this is not a pitch for it. I'm just saying, doing retirement planning, we do full service retirement plans. And so what that means is we help our clients even with things that we don't offer. So we don't do health insurance. We do Medicare if you need help with that, but we don't do health insurance, but we'll still help you kind of mitigate this and run the scenarios if you need help with that and you're working with us. If not, if you're just doing it on your own, this is how you do it. If you need some more help, I'm going to go ahead and link to our calendar. Doesn't cost anything, and basically we can sit down with you. We can go over this, other things. One thing that I personally like to do for anyone that I'm working with is we try to recreate your income that you were bringing home while you're working, if possible. And for most people, it is. And what we do is you kind of have these milestones in retirement that you have to get to. If you retire at 55, well, from 55 till 62, your benefit's going to be pretty low because you're not receiving Social Security, you're paying for insurance, you're doing all those things. So really you need extra income from 55 till 62. From 62 to 65, if you take Social Security early, some people want to, some people don't. We can discuss that if you want. But at that point, from 62 to 65, well, all of a sudden now you have Social Security maybe, but you still are paying for that insurance, which might be $4 or $5 or $600 or $700. Then from 65 plus, you have Social Security, you have pension, you have Medicare. Things get a lot easier, right? And so the key is making sure that you have a plan that factors all of that in without running out of money. And a lot of times you can retire successfully if you just have those little gaps of income filled throughout retirement. And that's where a retirement planner like us comes into effect. So if you want to meet with us, if you want to discuss options, it doesn't cost you anything to meet with us. There's no fees, there's no charges. If you like us and you want to jump in the calendar, I'll go ahead and link that below so you can do that. If nothing else, I hope this is a really good value to you, and I hope it answers some questions that you might have. Thank you so much, and I hope you all have a great day.